Hello, we're back at it again. And like I said in my lecture 2, we'll be solving a question today. So welcome to my lecture 3. As you can see, we'll be looking at this question on the left side of my screen, Fbx Ltd. If you look at this question, we'll only look at A, we'll solve A, B, and C of this question. The D part will be after we have dealt with overtrading and other forms of ways of managing account receivable. So what we'll do for today is to look at the concept that we have dealt with before and how to solve the relevant questions. And this time around, that will be in A, B, and C. Now let's look at this question. Very good question. Fbx Ltd. So we have Fbx Ltd. is a wholesale carpet seller that provides carpets to small and medium-sized retail businesses. The most recent accounts of the business are set out below. We have this financial statement. The statement of financial position is shown, and this is profit and loss account. The directors of Fbx Ltd. Have been pressed by the bank to significantly reduce the overdrafts. And I'm sure you know what overdraft is. Overdraft is a form of financing, excuse me, on a short term, which a company can always draw on as they need, right? But some of the directors wish to do this by reducing the operating cash cycle of the company, and they have set a target operating cycle of 50 days, with inventory and receivable days each being reduced to 45 days. Now, that is the part of the question we need to solve A, B, and C. So to be clear on what they want to do, they want the cash conversion cycle to be 50 days. That's their target. And they want inventory days and account receivable days to be at 45 days each. That's the target. That's the target. But let's look at the requirement of the question. Required, hey, explain the term cash operating cycle and state how the cash operating cycle may be reduced, and outline the problems that a company may face if it seeks to reduce its cash operating cycle. This A part of the question is very tricky, and pay attention, because these are one of the reasons why students believe they've done very well in exams, but they don't pass. A lot of students don't pay attention to questions in exams. This is a typical exam question that I got. This A requirement has 3 questions in it. The first one is explain cash operating cycle. That's the first component. The second component in that question says how cash operating cycle can be reduced. And the third part of this question wants you to discuss the problems associated with reducing cash operating cycle. If you don't address these 3 parts of the questions, you cannot earn the 8 marks. These 8 marks you have to address all of this. And usually this kind of question will be split into 2 marks, 3 marks, and 3 marks to end the total of 8 marks. So now let's deal with the first part of the question. What is cash operating cycle? We said cash operating cycle. In my previous lecture, I covered this. And I said cash operating cycle is the length of time from the period of outlay of cash as a result of purchase of raw materials or inventory, raw materials, or you call it inventory, and receipts of cash from the sale of goods. So remember what I said, it's a length of time between 2 periods. Period 1 is outflow when you buy, and period 2 is inflow from sale. So this period is your cash conversion cycle. And it's good to also put a formula to say cash operating cycle is calculated by adding account receivable days to inventory days and deducting account payable days. All of that will give you the full 2 marks for the explanation. So if you have done all of this and you believe you have done very well, you've only scored 2 out of 8 marks. Now, the second part of this same question says you should state how cash operating cycle can be reduced. So second part, from the formula, you know that the cash operating cycle is AR days plus inventory days minus AP days. So from this, you need to state at least 3 ways you can reduce cash operating cycle, 1 for each component of this formula. So one way of reducing cash operating cycle is by reducing account receivable days. And you can't stop there. If you stop here, you get half mark and not 1 mark. You need to state at least how. So you can reduce account receivable days. E.g., you can say by prompt follow-up on invoices. You can give another reason, early settlement discount, and so on. We'll cover how to manage account receivable balance as we move on in this lecture. Right. And another second way of reducing reducing cash operating cycle is by also reducing inventory days. And remember, you must state how. E.g., you can adopt can adopt just in time. Because just in time will reduce your inventory balance. And once inventory balance is reduced, definitely your inventory days will be reduced. Another way of reducing cash operating cycle is by increasing. Please take note. The other two is reducing, because from the formula these are positives. But for payables, a negative. So you need to increase account payable days to reduce your cash operating cycle. So by increasing account payable days, e.g., negotiate, usually the only way. Negotiate longer payment days. With suppliers. So all these three methods are various ways you can use to manage your cash operating cycle. And this will earn you additional 3 marks. If you stop there, you've only earned 5 marks out of 8. There is a third part of the question that I want us to talk about the problems associated with trying to reduce cash operating cycle. And you must say one problem for each of the components of cash operating cycle. So when you try to pursue promptly the invoices owed by customers, customers might be angered. And when your customers are not happy with you, you might lose sales. With inventory, if you adopt just in time, which means you only buy inventory when you have an immediate sale, you run the risk of stockouts, which is very dangerous. And when you try to negotiate longer payment days with suppliers, you might actually lose goodwill with suppliers, because they might think that you are running into problems, and because of that, they might stop selling on credits to you. When you see all of this, you have additional 3 marks. And that is how you earn all the 8 marks in the A part of this question. Now, the B part of the question. The B part of the question says, calculate the cash operating cycle of the company for the recent year. And that is 2 marks. So cash operating cycle says equals to AR days plus inventory days minus AP days. So which means we need to calculate each of these before we can get our cash operating cycle. So let's start with account receivable days. We said account receivable days is calculated as account receivable balance divided by credit sales multiplied by 365. So if we go to this question, we need to look for the account receivable balance. If you look at the statement of financial position, which is where you find account receivable. Account receivable balance, this is trade receivable, and that is 780. So that equals to 780 divided by the sales, which is in the statement of profit or loss account, that is 4850. Then multiply by 365 days. If you press your calculator, this will give us 59 days. The next one is inventory days. Inventory days formula is inventory balance divided by purchases, credit purchases, multiplied by 365. And looking at our statement of financial position, inventory is 460. Then cost of sale is 2630, which is usually adopted as purchases, multiplied by 365 days. Using a calculator, this will give us 64 days. Then lastly is AP days, which is equals to AP balance, AP balance divided by cost of sales multiplied by 365. Looking at the statement of financial position, our AP is 330 and the cost of sales remain 2630 multiplied by 365 days, and that is equals to 46 days. So we know all the components of our cash conversion cycle. We know the account receivable days now. We've calculated it. We've calculated inventory days and we've calculated AP days. Now we put that together. Cash operating cycle is equals to account receivable days plus inventory days minus AP days. Our account receivable days is 59 days plus inventory days, which is 64 days, and AP days is 46 days, and that will give us 77 days. So for this question B, the cash operating cycle is equals to 77 days. Now, this question did not ask whether this is good or bad, but in the future, you might have a question that's asking whether you need to comment on these days, whether it's good or bad. Usually, remember what we said, that the lower, the better. But looking at 77, how do you know whether 77 is good or bad? Usually, the question will give you a benchmark data. So it's either you do a trend comparison, which means you compare with previous years to see whether it's going up or coming down. Or they might give you what we call the industry average. Or they might even give you what a peer company. They might give you a peer company data. So you have something to always compare with to see whether your company is higher or is lower. If your company is higher than any of these, the company is not doing well. But if the company in question is lower than any of these, then the company is doing good. And that is B part of the question. Now, the last part of the question we'll look at in this video is the section C of the question. Section C says, calculate the amended inventory. So we need to calculate amended inventory, amended receivable balance, and likewise amended payable balance. All of this. And that is based on if the target operating cycle is reduced to 50 days. Remember, from our calculation, the cash operating cycle is 77 days, but they want to reduce it to 50 days with account receivable and inventory days being 45 days. And the question says we need to assume that revenue and cost of sales remain constant. So if this will remain constant and cash operating cycle needs to go to 50 days, and we are targeting account receivable days of 45 days with inventory days at 45 days as well. Then from our formula, we know that cash operating cycle is equal to AR days, which is 45, plus inventory days, which is also 45, minus AP days, which we don't know. So I'll call it minus X. All of that will equals to the 50 days target. So which means 45 plus 45 minus X equals to 50. And from these, we can estimate our account payable days, which will equals to, so if we take X over, so X will equals to 45 plus 45 minus 50. And X equals to 40 days. And that means our account payable days is equals to 40 days. So knowing all of this means that we can definitely calculate each of those balances, because from our formulas, let's start from the account receivable days. Account receivable days formula says that account receivable balance divided by credit sales times 365. And so if account receivable days is 45, then the revised account receivable that we are looking for divided by credit sales, which question says we should assume is constant. So divide by 4,850 times 365. So if we make account receivable balance subject of formula, so we rearrange the formula, which means that the revised account receivable that we're looking for will equals to 45 multiplied by 4,850 divided by 365. And if you press the calculator for that, 45 times 4,850 divided by 365. So the revised account receivable balance will be equals to $597.945. Remember to always put your currency. And for inventory revised balance, we know that inventory days formula says that is inventory balance divided by cost of sales multiplied by 365. Remember I said cost of sales will be used interchangeably as credit purchases. So inventory days is also 45 days, which equals to the inventory revised balance that we're looking for. Cost of sales has been deemed to be constant, so which means looking at our profit and loss account, it will remain at 2630. So 2630 multiplied by 365. Just like we did for account receivable, we rearrange this formula and inventory revised balance will be equals to 45 multiplied by 2630 divided by 365. So our revised inventory balance using a form calculator, 45 multiplied by 2630 divided by 365. So the revised inventory balance will be to $4.246. Remember? And lastly, revised account payable. Remember, account payable days formula says that AP balance divided by cost of sales multiplied by 365. AP days that we calculated, remember here, this one, 40 days. So 40 days equals to AP revised divided by cost of sales remain at 2630 multiplied by 365. So we arrange the formula and the AP revised will be equals to 40 multiplied by 2630 divided by 365. And if you use your calculator, 40 times 2630 divided by 365. And that will give us the revised account payable of $288.219 in dollars as well. So these are the revised balances as requested in question C. And that will be it for this video. In next class, mostly maybe in subsequent videos, if not the next one, we should be able to cover this section of this question. Until then, bye for now. Thank you for watching. Remember, I would like to have your comments in this section. If anything is not clear to you, you can ask your question in the comment. Hit the like button and also remember to subscribe to my channel. The more subscriptions I get as well, I get motivated to do more videos for you. Thank you. Bye for now.